Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by MarketDesk Research. I'm very pleased to have with us this afternoon John Clements, the Managing Director of MarketDesk Research, who will be speaking about that sector investing and focusing on the key drivers. So with that, John, I'm going to go ahead and pass the controls over to you. If you would share your screen, let's get underway here this afternoon. Thanks for joining us, John.
Hi, Cynthia. Thank you. Can you guys see the screen correct now?
Oh, looks beautiful. In full screen.
Phenomenal. Well, thank you everyone for joining today's call. We're going to walk through, as Cynthia mentioned, really sector investing and how our team here focuses on finding the key drivers of risk and return and really how those shift over time throughout different really, market environments. To get the important disclosures and the legal out of the way, just as a reminder, the information herein is obtained from sources which MarketDesk Research LLC believes to be reliable, but we do not guarantee its accuracy. Neither the information nor any opinions expressed constitute a solicitation of the purposes or sale of any security or related instruments. MDR is not responsible for any losses incurred from any use of this information. Please carefully read the full notice and disclosures at the end of the presentation. Now that we got the legal out of the way, today's focus primarily is going to be on really two different areas. So again, what are the key drivers of risk and return? And then second, how do we monitor these different inputs as they rotate in importance, right? Because areas obviously like 2020, very focused on COVID-19 pandemic, is a very different environment than we were in 2014 or 2017, for example. So paying attention to these drivers as they rotate amongst kind of the importance level for investors. First, we'll hit on the current ratings that we have for the MarketDesk Research as far as across US sectors here. We'll then hit on the performance and then highlight those drivers of risk and return. We'll also give you a kind of a quick preview of our framework for stock picking versus sector allocation, kind of the two regimes that we think the market falls into. Also, we'll highlight the importance of earnings growth as well as the volatility across different sectors and how that plays in to performance. And then we'll walk you through the full process that our team does here internally as far as investing across different sectors and how we really follow them on a kind of a longer term investment basis. So first about MarketDesk Research, just quickly to give you my background. Previously, I was with Goldman Sachs Research in New York, providing equity research to hedge fund clients out of New York and London primarily. And really what MarketDesk Research does is similar, solutions, right? We have kind of longer term strategic ratings focused across sectors, factors, international markets, and credit. Think of more of a 12 to 18 month horizon, and then tactical opportunities, which are more of a near term opportunity, really kind of more of a 3 to 12 month or 6 to 18 month horizon. And that could focus on individual industries, countries, themes, or even kind of more macro or tactical or technical ideas as well. And then I believe Cynthia will mention at the end of the webinar here how you guys can access to get signed up for the free week trial to get access to MarketDesk Research. So to highlight our current ratings provide here, so overweight currently communication services, technology, and healthcare. Underweight energy, financials, and materials. We recently downgraded energy and upgraded consumer staples. I'll walk you through the analysis in the back as to what led to that decision as well. But just to know, this is kind of a high level overview and a quick rationale here as to why we prefer those sector ratings. We do track the performance of all of these different sector ratings as well, right? So across the past 1 month, as well as a longer term horizon since the inception, basically, of our ratings last fall, November 30th of 2019. So you can see how the performance has panned out thus far. Page 6 here, really get into just why this webinar is important, right? Why is sector investing such a unique area to get exposure to? And really it comes down to performance can vary drastically, but then also at the same time, while you have that variance in performance, you also are benefiting from diversification, right? To where if you were looking at, instead of 11 different sectors, 11 individual companies, there's a ton of idiosyncratic risk that falls in all those individual companies. By investing in sectors, it actually simplifies the process quite a bit, right? And so we'll walk through the drivers of really kind of the risk perspective as well as from a return perspective. And there's important things to pay attention to as far as unique drivers such as oil for the energy sector or interest rates for financials, but all these different drivers really show you how performance can vary, right? So across sectors as well over the past 12 months, but then also from a cyclical or defensive perspective, highlighting the two different regimes from more of an economic standpoint as well. And so as we hit on those, today's focus will primarily stay on the drivers across all the sectors, but it is important to pay attention to the unique sector drivers as well, right? So of importance, interest rates impacts financials, real estate and utilities. The price of oil and other commodities obviously impacts energy. The prices of materials like copper and steel are heavy input into materials, right? Geopolitical risk and different actions and events that are taking place are heavy for really kind of heavy export industries and important to follow. And then government regulation really impacts healthcare and the financial sectors here within the US. Those are all idiosyncratic drivers for each of the individual sectors that you have to pay attention to. But then when we think about comparing sectors versus each other, we really kind of fall into 5 different categories here. Relative earnings power, relative price momentum. So we'll show you some statistics there that we pay attention to. Also relative valuations, as well as investor sentiment, and then also what factors, as factors have become much more important over the past decade and investors are starting to use them more, to highlight what factors are really driving sector performance across all of the 11 sectors here. First, we'll highlight just a framework that we have for really kind of thinking about whether we should be in a stock picking or a sector allocation, environment, right? And so we use 2 different inputs to build this chart. The first one is performance correlation, you'll see along the bottom here. And then on the left-hand side, you'll see the dispersion in valuation. And so what this analysis really does is we kind of think of the market as in 2 areas, whether you're focusing on looking at individual securities within the sectors or focusing on sector allocation, right? And so what it does is let's just use materials, for example. You can see how correlated are all of the companies within the material sector, and then how dispersed are their valuations, right? Something like technology, for example, where the individual names like Zoom, for example, or Apple might be trading different from the names of like IBM or Cisco. Performance has come down, but there's a tremendous amount of dispersion in the valuations. We would lean to focus more on individual security selection for a sector like tech, but then something like energy, right, where valuations have come down across the line and the correlation across all the individual names within the sector are extremely high. It makes more sense to get broad exposure to the sector and less focusing on individual security selection and put that effort towards areas like communication services or technology, for example. So we update this on a monthly basis here internally. We do track also where the cyclical average and the defensive average is moving for those different sectors that fall in those categories. But it's a really quick way, a quick snapshot to highlight, again, stock selection versus sector allocation. The other thing on page 9 that we want to highlight is really, you got to be very aware of what the current environment is focused on. With the rise of the COVID pandemic and seeing some of the more volatility increasing year to date, earnings has become an important indicator for investors, right? And so something we've built out internally is to track how investors view earnings, right? So you can see going back through 2019, there wasn't a whole lot of importance placed on the earnings across sector allocation. But then as we saw the market sell off and COVID cases pick up, we saw a spike. We also saw a spike again over the summer months. And so how we build this indicator, just to give you behind the scenes, is we look at the 3-month rolling correlation between the next 12-month EPS revisions for each sector, as well as the performance. So for example, when we saw technology seeing some of the better revisions taking place going into the spring of previously this year, as well as the summer, we also saw the performance of tech follow those revisions. Therefore, investors are paying much more attention to earnings than they were, for example, in August or October of last year. So again, you have to be very aware of what the current market, and I think you can get a pretty broad sentiment, if you will, from just paying attention to the news, right? So everything from following newspapers to paying attention or talking to other investors. What are the key topics that investors are mentioning when they talk about the markets? What are the risks that they're worried about? These are going to be unique drivers that do rotate that are important to pay attention to. So this earnings importance indicator is something that we look at on a monthly basis here internally to really pay attention to those different opportunities. Focusing also on stability of earnings, right? So again, think about when we saw the Fed lower interest rates earlier this year. We saw we saw the price of oil drop as well this spring. That all increased the volatility of earnings in sectors like the financials or like energy or like materials, right? Again, given the investors' focus on increased volatility broadly across the markets, they also want to find companies and industries and sectors that can grow in the current environment. When you think about that, it's areas like healthcare, for example, or consumer staples, think like Walmart, for example, or REITs, which have pretty consistent earnings power, or something like technology or utilities. More or less, we're going to want to be focusing on these sectors in the bottom cohort here that have lower volatility, that are more predictable when you think about earnings going forward, and then really paying attention to how that is playing out. When you look at the top half of the list, this has really been some of the more volatile names year to date. And it's not like there was a massive uptick except for consumer discretionary year to date. Industrials, financials, and materials have all been pretty volatile for a long period of time. This analysis goes back over the past 5 years. So again, another area of analysis that we pay attention to, trying to really build the picture internally here of what investors, what the market is paying attention to, what areas are they watching going forward, right? So given the uncertainty, we would prefer lower volatility EPS growth sectors like technology, healthcare, utilities as well. We upgraded that to neutral from underweight in July of this year, as well as, kind of avoiding areas that are more volatile like materials and financials. And then when we think about kind of the drivers that we pay the most attention to, and we'll start to dive through them across specific sectors, we really split them into two different levels, right? So the first level is much more focused on relative earnings growth, right? So that could be everything from blended earnings growth to also paying attention to price momentum. So price momentum, we'll show you, is a pretty unique area to pay attention to because it combines so many different areas of analysis. Also focusing on sector breadth, which here we'll pay attention to both the percentage of companies that are outperforming the S&P 500 within each sector, right? Over the last 12 months, what is the percentage of healthcare companies that have outperformed the S&P 500? And then we'll also pay attention to the high-low index from a sector breadth perspective. When we think about looking at ratings changes, these three areas are the most, at least recently over the past 3 years, have been the most important areas for us to pay attention to internally. They've been the largest drivers of returns. By and large, when you think about areas like valuations, a lot of people will focus on like value versus growth, right? Which is a unique story that's unfolding, but valuation doesn't tend to be a catalyst for future performance. Investors are focusing on where earnings growing, where's other capital moving, price momentum, and then what's the breadth? Is there a lot of money moving there, or is there just a little bit of capital? So focusing on these three areas first, and then focusing on where's the relative valuation versus historical levels, where are ETF flows trending, and then also what factors are driving performance. So we'll focus on these two different levels, first on the first level drivers. And before we get to that, these are the 6 charts that we pay attention to on a monthly basis across 6 different areas of analysis that our team always looks at internally. And so we'll walk through them pretty briefly here. So the first one is implied next 12-month returns. And so what this analysis looks at is it looks at the past 15 years of returns across all of the sectors, and you can see them abbreviated here. And you'll see in dark blue being the implied next 12-month returns, and then light blue being the last 12-month returns. And so what this analysis looks at is over the past 15 years, when there's been when there's been something like energy down 38%, how has the next 12 months return typically? What's it typically been? Versus something like consumer discretionary, when you think the last 12 months returns have been 26%, how have the next 12 months returns typically been? They've actually been amongst the highest, right, across the sector. So statistically, where is the market historically going to be trending based on the data that we know? We also look at the breadth from a percentage of each sector trading above its 50-day moving average, right? So areas like consumer staples, like Walmart, again, when this analysis was ran, was very strong. Same with healthcare, same with industrials and tech, but areas like energy or utilities or real estate, not seeing a whole lot of strength across those areas from more of a 50-day moving average perspective. Number 3 here, we pay attention to revisions as well, right? So tracking where other Wall Street analysts are publishing results over the past 1 month, as you can see here along the bottom, and then the past across the past 3 months as well, right? And so paying attention to those, what sectors are continuing to see upward EPS revisions versus which ones are potentially seeing no upward EPS revisions or very little. Again, we want to see breadth from an earnings perspective as well as from a performance perspective. In the bottom left here, number 4, we pay attention to a unique metric where we kind of think about, again, where are flows trending, but then also where is performance? What gets really interesting is when you think about places like utilities, for example, which have seen negative returns of late, but actually a lot of flows moving into the sector, versus something like energy where we've seen poor performance and then also investors leaving the sector, right? Ideally, we want to be finding areas like utilities, areas that might be performing poorly, but you're starting to see a lot of capital moving into those sectors. And then obviously there's been much more momentum and growth driven names like Amazon and consumer discretionary, as well as the technology sector. So obviously names like these, technology, consumer discretionary, and industrial, seeing continued momentum growth there. So really more or less paying attention to the right-hand side of the screen, where are flows moving across sectors. We also look at the cyclical versus defensive rolling last 12-month returns and how that compares to the broader S&P 500, right? And so from a cyclical versus defensive perspective, we pay attention to consumer discretionary returns versus consumer staples. And what really is interesting is you can see them pretty correlated today, but when you look back at the start of 2020, the S&P starting to fall apart, and then cyclicals quickly there following that, right? And so paying attention to kind of what is the dynamic, what's the regime, or what's the investment environment for this breakdown across sectors. And then lastly, looking at the correlation with the S&P 500. We've seen broadly correlations tick up across the past 12 months for the S&P 500 across all of these sectors, but we do show where the 2-year average has also been across this. We did have a question come in asking about what NTM is here. So NTM stands for next 12 months, thinking about the next 12 months from today. LTM is the opposite. I think it's about last 12 months. So the previous 12 months leading up to today. Really kind of think of it as a 12-month horizon going forward as well as backward. Also looking at coming into the first driver, relative earnings growth. So we think about 2 different areas of analysis here. The first is looking at relative EPS growth. So where is the sector growing versus the broader S&P 500? To do this, we look at blended EPS growth, which averages the last 12 months as well as the next 12 months. So when we blend that, where is, for example, this is the healthcare sector, where is that growing versus the broader market? The other area of analysis we pay attention to is EPS revisions. So what percentage of the sector is seeing upward EPS revisions versus the S&P 500? So again, the sector healthcare here seeing higher revisions, have seen higher revisions through much of the past 12 months as well. So again, an area of strength. And we highlight 2 improving and 2 deteriorating sectors here. So you see healthcare and technology from a relative earnings growth perspective as 2 of the most improving sectors. And then deteriorating, you see financials and energy. Financials, again, from an interest rate perspective, and energy from an oil perspective, seeing a lot of EPS downgrades. The second area, again, that we pay attention to here is revision. So again, thinking about the 4 same sectors on the previous page, healthcare, where those are trending, same for technology, and then also thinking about financials and energy. So it's very important, again, even you think about financials and energy as 2 potential sectors which are trading at very material discounts. Investors in the current environment are rewarding sectors that are continuing to show growth, that can grow in an environment like the COVID pandemic, right? So paying attention to where those are and then tracking those in the back and saying, at the moment, earnings is more important than valuations. Price momentum here, we pay attention to 2 different areas of analysis. We look at the sector's year-over-year return, right? So think of this as the same as the rolling last 12-month return for the sector. And then in the shaded gray area, you'll see the next 12-month return, right? So this is something that we pull forward, for example. So the way to think about this is when this sector saw down about 60% going into the financial crisis, the next 12-month returns were about 60% as well. So you just basically look vertically up to see where the next 12-month returns played out. We also show you standard deviation bands here as well, right? So 1 standard deviation plus and minus to highlight statistically where the sector should see support given historical data. Then we show the same analysis, but versus the S&P 500. So again, how is the sector trading versus the broader market on a relative basis? And what's interesting and why we really enjoy using something like year-over-year returns is it's really multidimensional, right? As we mentioned here on the bullet point on the left, it combines a lot of different areas of analysis. It combines momentum, it combines breadth, statistics. It also looks at technicals, reversions to the mean. So you think about all those 5 different areas of analysis really in one line. That's why we enjoy paying attention to a lot of multi-dimensional areas of analysis. So when we come in, we first look at the year-over-year returns for the sector. 2 areas that are improving that we think have statistical upside: consumer staples as well as energy from a statistical perspective. You'll see that on a year-over-year versus the sector, and then a year-over-year versus the S&P 500. And then 2 areas with statistical downside, looking at the tech sector and communication services, 2 areas that likely, based on historical levels, will see muted next 12-month returns. Next, hitting here on sector breadth. So we pay attention to 2 different areas of analysis here. First, looking at the percentage of companies across all of the sectors that are outperforming the S&P 500, and then looking at the high-low index, right? And so the high-low index is calculated by basically looking at the percentage of the sector with new 52-week highs over the past year, how many companies are hitting new price level highs, versus the percentage of the sector with new 52-week lows, and you subtract 50% from that analysis. And what it really does is it splits the sectors into which sectors are seeing uptrends versus which sectors are seeing downtrends. And so when we look at this across sectors as well, healthcare and technology as 2 of the stronger sectors that are seeing strong performance on a relative basis versus the S&P 500. And then you think about sectors that are potentially deteriorating. When you look at this metric, it's areas like utilities or like financials again, right? So again, we want to see sectors that there's not one individual name driving the performance of the sector. We want to see really strong breadth across the entire sector as far as performance. And then looking at the high-low index as well, you'll see, again, the same sectors here: healthcare and technology, both in uptrends, and then sectors that are in downtrends, think about utilities as well as financials. Coming into the secondary level of drivers, first starting with relative valuation. So this is something where, again, I think a lot of people have seen previous, areas like, energy and financial specifically, which are trading at deep discounts, continue to underperform. And again, it's important to remember valuation is not necessarily a strong catalyst. It can support an individual sector, but it's not necessarily going to be a catalyst to drive it forward, right? And so the 2 different areas of analysis that we pay attention to here is first looking at the next 12 months PE versus the S&P 500. So if you think about the earnings over the next 12 months, where is it priced at versus that, and then compare that to the S&P 500 level. And then we look at the valuation composite, right? So the valuation composite is basically an average Z-score of 5 different areas of analysis. So the last 12 months price to earnings, the next 12 month price to earnings, price to book, EV to sales, and EV to EBITDA as well, right? And so the Z-score is basically just a statistical term for the standard deviation level, right? And so when you look at this chart, you'll see 3 being +3 standard deviations, -3 being -3 standard deviations. And so again, this is another area of multi-dimensional analysis that we'd like to pay attention to, because the reality is, and there's a lot of investors on this webinar here, everyone has their preferred evaluation metric to use. When you combine all of them and then put them in a statistical measure such as a Z-score, you're really combining several different areas of valuation analysis and also combining investor preference, right? There's no weakness to be necessarily just relying on earnings when everyone else is focusing on price to book, right? So we like these areas of multi-dimensional analysis. And so when we look at the first valuation, relative valuation analysis, we're looking at the next 12-month price to earnings, real estate being one of those, right? And then financials also being another area where it's fallen below its statistical bound, right? An area where it might be, again, getting a bit out of hand. And again, unfortunately, for something like financials and also like real estate, these are areas which are more driven by something like the Federal Reserve and their monetary policy with interest rates. So again, there's some areas that externally you cannot necessarily, you have to think about the whole picture, right, when you're thinking about sector investing. And then on a valuation composite as well, you'll see again the S&P 500 here in the blue line, trading about 2 standard deviations above its long 15, 20-year average. And then in the dark blue, looking at real estate, and then the gray line here showing you the gap between those two sectors. And the same for financials as well in the bottom right. And then looking at two sectors that we think are expensive on historical basis is technology and industrials, right? So on a next 12-month price to earnings here on the left-hand side, and then on the right-hand side, paying attention to those valuation composites. Both of those, for example, in industrials trading above the S&P 500, same with technology, right? So two very expensive sectors. And again, you got to pay attention to the different valuation levels. The other area of analysis that we pay attention to is the ETF flows. And so what we're tracking here is really, again, where are investors preferring, where's the investor sentiment shifting across different sectors? And we really kind of highlight, look, what sectors are investors keen to get exposure to the future, right? So where are they paying attention, where they want to buy exposure to over the next 12 months? And so ETF flows are really informative from a more of a framing of the mindset, right? And so as we go through the analysis here, you'll see two different sectors here that we see as improving, both energy and technology. So energy seeing a recent 1 month outflow, but if you think about kind of year to date for the S&P, for the year to date for 2020, energy being one of those sectors that has continued to trend up, right? As of late, some outflows coming out, but again, I think that's more of a model change rather than a change in sentiment from investors trying to get broader exposure. And then the other sector, which has continued to see inflows, has been the technology sector here as well. Two deteriorating sectors being materials, something where we've seen consistent outflows, and then real estate as well, really picking up over the past 12 months to where 2019 was a bit more muted and actually net inflows going into the sector. We've actually ticked on a last 12-month moving average perspective, negative for the real estate sector. And then the last driver that we pay attention to here is different factors, right? And so we track essentially what factors are driving industry performance. So think broadly about, a sector like healthcare, for example. You have something like biotech, which is much more of a growth and a momentum-based industry. And then you have areas like, nursing or hospitals, which might be more of a quality or value-based, right? And so what the analysis here looks at is what factors are driving industry performance across all of the sectors. And so you'll see the way the analysis is built is you'll see the color code based on what factor drove the highest performance for each month. And then the bar is basically what was the average monthly return across all the industries within that sector. At a high level, we think when investors are paying much more attention to quality and value factors, it's much more of a bearish nature, right? For example, think about the energy sector when the market sold off in the spring. Investors were rewarding industries within energy that were more of a quality or more of a value tilt, right? To where when you think about industries like software, right, and the technology sector, we prefer to own sectors that are seeing momentum and growth as the main driving factors. It's more of a bullish sentiment when you think about investing across different sectors. And so when you think about momentum for materials being over the past 2 months here, being something where we saw a shift again from the sell-off, investors paying attention to quality in materials over the past 3 months and then focusing on value, and then now making that shift to focusing on momentum industries within materials. Same for consumer discretionary, right? So when the market sold off, paying a much more attention to areas like growth, but then also shifting that into momentum individual industries. You'll see the same analysis for industries like utilities and energy, which really are much more focused on kind of a quality or a value basis. And so in kind of summarizing, the webinar here, really the main takeaways are, think about it like this. Sector investing is something where you can see a tremendous amount of variation in returns, right? So it allows for outperformance if you're paying attention to the right drivers of risk and return. And then in areas like 2020, where COVID has been a massive area of investor, importance and sentiment, it's really important to pay attention to the drivers, right? For example, earnings being much more powerful and kind of of a COVID world, right? And then also hitting on sectors, right? Sectors all have unique drivers as well as common relative drivers. So if you're focusing on an area like energy or financials, you have to pay attention to the unique drivers such as the price of oil or interest rates. But then you also have to be aware of where are the relative drivers. Where is the relative price, year-over-year price return for the sector? Where is the relative earnings growth for energy versus the broader market? You can't just be focused on something like you think the price of oil is going to rebound or valuations or low. And then also the last 2 points, we really enjoy hitting on areas like combined analysis, right? So this is areas where it's more of a multi-dimensional frame of mind, right? So something like blended earnings growth, we're paying attention to both the last 12 months as well as the next 12 months earnings growth, valuation composite, where we were combining 5 different valuation levels. And then again, year-over-year return, combining a lot of different areas of analysis, everything from statistics to reversion to the mean to technicals, all combined in that year-over-year analysis. And again, it allows us to really account for a lot of different preferences and kind of reduce the vulnerability of relying on just one of these areas of analysis. And then obviously no driver can predict future returns. So it's really important to use several different drivers when you're thinking about sector investing. You know, you can't just rely on earnings. You can't just rely on year over year or valuation. You really have to pay attention across all these different areas of analysis. They will vary in importance, but you have to keep them all top of mind. And then I think we've reached the end of the session here. So we've had a couple of questions come in, but I'll let Cynthia hop in and make sure everyone knows how to enter questions.
Well, thank you very much, John. And what I'd like to do right now is remind each of you, if you've got any questions for John, go ahead and add those into the questions panel. There's a title bar located on the right-hand side of your screen. Simply double-click that questions title bar, and you can enter your questions there. And while you are adding questions, I did want to let you know that MarketDesk Research is also a research provider with access to or that has been integrated into the Trader Workstation platform. So let me take a quick moment here, and what I'm going to do is take you over to the Interactive Brokers website where you can find out more. Let's go. First, let me go ahead and put my slides on home, and then what I'll do is share my desktop. So let me see. Let's go ahead and get in. And from the Interactive Brokers website, if you'd like to learn more about MarketDesk Research and how it's been integrated into the platform, simply go to the pricing menu. Locate one of the drop-down menus on our home site. You'll find here that MarketDesk Research is listed under the Research and News tab. Now notice here, I've already gone to that tab. You'll see MarketDesk Research has been added here. You'll find, notice that there's a description of the research that's available, and it also does show you in the lower right-hand corner of this window that that research is available through the legacy or our desktop Trader Workstation platform. Now simply go in to learn more, and you'll find here is a link to MarketDesk Research, and notice that we even do include a link for the specific website. Now, once you do subscribe, you will need to subscribe to MarketDesk Research, but once subscribed, you'll be able to locate that research integrated into the Trader Workstation platform. Notice if you simply go to the New Window button here, you'll find analyst research is provided. Now, those features that you do subscribe to will appear up at the top of the list, but also notice that under those available, we do have MarketDesk Research. So here's where you'd be able to pull up that research directly through your Interactive Brokers Trader Workstation platform. So a quick look on how to access this information. And now I do see that some questions have come in, so I'm going to turn this back over to John for you to answer. John, I'll go ahead and allow you to share your screen once again. And let's take on some of those questions. And remember, you're muted. You'll need to unmute yourself.
There we go. Yeah, a couple of questions came in. The first one asking about the utilities. So let me just go ahead and read that so everyone's aware. All right, so what is your current opinion on the outlook for the utility sector in light of the very low interest rate environment? And so I think you can see the screen here as far as where we have utilities as a neutral ratings, right? The thing that you have to be very aware of, obviously, investors, they all dictate, kind of the framework that other investors view each sector by. And utilities, I'd say, is at the top of the list as far as being heavily reliant on investor sentiment. It's going to be one of those sectors where when volatility picks up, utilities will be one of the ones that performs at the higher end of the list, right? From a defensive perspective, we do prefer consumer staples over utilities, right? And it's really more of a revenue growth perspective. I think a lot of utilities pay incredibly high dividends, and there is concern, at least internally here, I think, when we discuss the utility sector as one of those sectors that potentially could see issues if they don't show areas for growth or revenue growth to be able to cover the dividends as well as show areas to invest and grow their firms. You think about it, it's very different from something like consumer staples, where they aren't necessarily known as obviously a lot of consumer staples do pay high dividends, but they aren't necessarily known as a dividend sector or solely reliant on a dividend sector. And so areas like consumer staples will also be heavily reliant on investor sentiment. So if there were to be a broad market sell-off in the fall here, we think consumer staples would be an area we'd prefer to be in over utilities. The low interest rates also is concerning. Obviously, I think there will be a ton of capital moving towards areas that do pay high dividends, right? So utilities has that tailwind, but you're going to be very reliant on kind of where broad interest rates move, and where monetary policy moves within the U.S. So if that continues to stay low and kind of beyond the 2-year, time horizon that the Fed has laid out, then utilities could do even better as investors bid down that dividend yield. But if you're thinking about it from a defensive perspective, we would prefer to own consumer staples there over utilities. Another question we had come in, so it says, do you see any correlation between sector performance and the phases of the economic cycle? It's a great question. It's something we've done a ton of research here internally, and the answer is twofold. Obviously, economics, the economic cycle, both in the US and globally, is important to pay attention to. But at the same time, it's not been historically the best driver of returns, right? You'd think broadly when the market sells off, areas, heavy export industries should underperform, and then areas defensive should, that have more of consistent revenue should outperform. And that does by and large play out. But when you think about putting it into statistical analysis, and we've done a lot of work here internally, it's one of those things that we, again, have to pay attention to from an environment and kind of what our investors focused on. But at the same time, there's other areas that are more important, like thinking about earnings growth or thinking about price movement over the past 12 months that we're much more focused on. Again, obviously in areas like recession, the importance of the economic cycle ticks up to where when you think about the past 10 years when the economy has done broadly well as it recovered from the financial crisis, it's been less of a focus. So I do think there'll be a lot more discussion increasing going into really the next 24 months around the economic cycle and thinking about sectors like technology, which is really a global industry. They have a lot of clients internationally, as these are really software, software's continue to grow as an importance area within the technology sector. And then there'll be sectors which are really US focused here domestically that, again, it'll be having to pay attention to not only the US economic cycle, but globally on economic cycle perspective. And then another question we just had come in as well. So how often are you reviewing the analysis? How often do you make sector changes? So this is something where we're very big believers in not overthinking and not overworking the problem. We do analysis on a monthly basis. So, we think if you're in there looking at a sector changes on a weekly basis, it's almost too near term. You might be missing broader trends and be overtrading a portfolio or overtrading kind of your allocations. On a monthly basis is where we found it to be quite well. And again, come to the performance here. So again, it's not like we're going to be missing out on any specific trends by using monthly analysis. And it also helps us avoid overthinking current areas that are playing out as well. And then the last question, it looks like we'll answer here that just came in. Does fundamentals or sentiment drive sector returns more? And so look, again, it's a great question. At a high level, think of it as they're both important, but paying attention to what is driving the current environment is the most important level to pay attention to, right? So, you have to be in, paying attention, reading the news, paying attention to talking to other investors, reading different forums, watching different interviews with the Federal Reserve and different monetary policies. What is the broad conversation topic at the time? That will kind of help you isolate what drivers to pay the most attention to. And I think that's all the questions we have, Cynthia.
Well, excellent presentation, John. Thank you very much. And I also would like to thank all of you for your participation here this afternoon and remind you that we have been recording today's event. So if you do want to come back and listen or re-listen to any of the concepts that John went through today, simply watch your inbox later on this afternoon for a direct link to today's recorded playback, as well as access to the same slides that John has been using. By the way, if you don't want to wait for that recording link, we do have the slides listed and they're available so that you can download before you do exit today's session. Notice on the control panel on the right-hand side of your screen, you'll find that handouts pane. Simply double-click and take a few seconds and download the slides today. So with that, we are going to conclude our session. I want to thank all of you for your participation here with us this afternoon, and special thanks to MarketDesk Research and John Clements for the presentation. Have a great rest of your day, everyone. You can exit using the X in the upper right-hand corner of the screen. Have a good one, all. Thanks.